Welcome to Atlantic Capital Markets Share Tips for the year 2022. In this video, we'll give you our top 5 companies that we believe as an investor you should take a close look at next year. We'll give you a full rundown of each company's recent performance and we'll give our detailed thoughts on their outlook over the coming year, both from a macroeconomic perspective and a simple technical analysis perspective. We'll also summarise market analyst feelings across the industry as well towards each respective company for the coming year. So to set the context of our analysis, let's start with a brief outlook of the UK economy for next year. The UK economy was one of the hardest hit from the pandemic, contracting 10% in 2020, performing worse than almost all other major economies. So it stands to reason that the UK economy had a strong bounce back in 2021. In fact, the British economy grew an impressive 6.9% in 2021. The Bank of England expect the UK economy to grow at 4.6% in 2022, regaining its pre-pandemic level in the first 3 months of the year. Inflation has been a key theme in 2021 in the UK, but also globally as economies reopened after the pandemic and as the UK navigated through Brexit. Global supply chain disruptions, in addition to labour shortages and, of course, surging energy prices, combined pushing UK inflation to 4.2% in November, its highest level in a decade. Furthermore, the Bank of England expect consumer prices to continue rising as the central bank forecasts inflation hitting 5% in H1 next year. Even so, high inflation is not expected to derail the UK economic recovery. The BOE is widely expected to raise interest rates in February in an attempt to keep a lid on inflation and bring it back towards the central bank's 2% target level. Now, this would make the Bank of England one of the first major central banks to raise interest rates post-pandemic. So as such, it could be good news for the pound, of course, particularly against the euro or the Japanese yen, and given neither the ECB nor the BOJ are expected to raise interest rates in 2022. Whilst the economy has recovered well from the pandemic, risks do still remain. A resurgence or indeed the emergence of a strain that can evade vaccines could threaten to put the UK back into lockdown, which then of course could derail the economic recovery. Brexit risks also remain. Given the timing of Brexit, the 31st of December 2020, it is difficult to disentangle the impact of Brexit and the pandemic with supply chain issues, labour market shortages and reduced output, also all a result of the UK leaving the EU as well as potentially owing to the pandemic. Relations between the UK and the EU remain strained throughout 2021 and there is still potential for that trade deal to fall apart amidst ongoing problems surrounding the Northern Ireland Protocol. Still, we're not there yet. So let's now take a look at our top 5 picks for 2022. Our first pick is DS Smith. DS Smith is an international packaging group which offers sustainable, plastic-free packaging and integrated recycling services to customers across the globe. DS Smith has operations in over 34 countries and around 30,000 employees. DS Smith provides cardboard boxes to e-commerce firms and sells boxes to food and consumer groups. It counts powerhouses Amazon and Unilever amongst its client base. So, how has it performed in 2021? The share price rose steadily across the first half, hitting a 3-year high in September of £4.66, before dropping 23% between September and October to £3.56. The price has risen 8% in 2 weeks from the low. The steep drop in the share price across the second half of the year was most likely owing to macroeconomic pressures from both the pandemic and Brexit. Inflation started to rise, pushing up the cost of raw materials, freight and haulage, increasing supply chain costs. However, these are industry-wide problems and are expected to start easing in 2022. The latest trading update was encouraging, half-year revenue rose 22% to £3.4 billion, and volumes reached record levels thanks to strong demand for retail and sustainable packaging. The group reported particularly strong growth in the US and Southern Europe. DS Smith's key markets, e-commerce and consumer goods and food goods, are strong and are expected to remain in good shape. DS Smith has literally made itself a key part of the supply chain. With environmental concerns increasingly important to both consumers and investors, DS Smith, the sustainable packaging provider, is well placed. Consumers are keen to move away from plastics and online shopping, and it's unquestionably here to stay, boding well for the outlook of the firm. And then there's the dividend. The dividend is back after a COVID pause, and 4.1% yield looks maintainable. As we mentioned, costs are rising and debt is a touch higher than ideal, but DS Smith is well positioned to outperform as those macro factors start to ease. According to the Financial Times, the 13 analysts covering the stock have given an average target price of £4.60, a low price target of £4 and a high price target of £5.88. From a technical perspective, after falling from £4.62 in September, the DS Smith share price is consolidating, capped on the lower side by £3.56 and on the upper side by £4. Buyers, supported by a bullish MACD, could look for a move over £4 to expose the 100 SMA at £4.10. A move above here could negate the downtrend. It would take a move over £4.60 for the long-term bullish trend to be back on track. Sellers could look for a move below £3.56, the December low, to target £3.15, the October 2020 high. Our second pick is Rio Tinto. Rio Tinto is the world's second largest metals and mining corporation. The Anglo-Australian multinational produces iron ore, copper, diamonds, gold and uranium. So after some volatility at the start of 2021, Rio Tinto's share price consolidated around £61.30 across Q2 before falling lower from August. The share price trades around 30% lower from the 2021 high and around 11% lower across the year as a whole. The share price appears to have reached a floor below £44 and could be attempting a recovery. The price of Rio Tinto dropped steeply in the second half of the year as iron ore price plunged. Around 60% of Rio's revenue comes from iron ore. Iron ore prices peaked at $233 per tonne in May before falling as the demand outlook in China darkened. China is the world's largest consumer of metals. Therefore, the price metals such as iron ore and copper are very dependent on the health of the Chinese economy. As the economic recovery in China slowed and fears of a default by Evergrande rose, metal prices declined on fears of collapsed demand. Volatile commodity prices are a factor to be considered when trading miners. Given the exposure to the Chinese market, the economic outlook of the world's second largest economy is also key. Beijing has increasingly been signalling that it intends to pivot towards supportive policies, with decisions expected to be more pro-growth in 2022. This could be good news for those base metal prices, such as iron ore. The dividend at Rio Tinto must of course be mentioned. The miner pays a yield of 10.92%, which is so high partly due to the fall in Rio Tinto's share price, but also owing to a stellar year after pre-tax profits rose 271%. Whilst the yield may not stay at this level, it is expected to remain relatively high. According to the Financial Times, the 21 analysts covering the stock have given an average target price of £52.18, a low price target of £40.19 and a high price target of £66.54. From a technical perspective, Rio Tinto broke lower in mid-August after hitting a high of £66 early in the year. The price formed a series of lower lows and lower highs, hitting support at £43.70. The price has rebounded off this level, retaking the 50 SMA. The RSI is supportive of further upside whilst it remains out of overbought territory. Buyers will be looking for a move over £51.60, the October high, in order to continue scaling higher. Sellers could eye a break below 43.70 as a sign of further downside towards 42.50, the November 2020 low, and beyond. Our third tip is Smith & Nephew. Smith & Nephew is a British multinational medical technology company. It develops, manufactures, markets and sells medical equipment and services. It's most renowned for producing advanced wound management products, clinical therapy devices and orthopaedic reconstruction products. Smith & Nephew sells products in over 100 countries across the globe. So, how has it performed in 2021? Well, Smith & Nephew has fallen 27% from its yearly high, reached in early January. After rising to £16.80 in January 2021, the share price steadily declined and currently trades at its lowest level this year around £12.10, a level that was last seen in spring 2020 when the pandemic first hit. Smith & Nephew was hit hard across the pandemic as the number of elective surgeries fell dramatically. The troubles for the stock didn't end there, as growth was also hampered by supply chain issues, which have rocked the global economy. After falling 20% since the start of the year, Smith & Nephew has the potential to stage a strong rebound in 2022. The interesting point about Smith & Nephew is that demand hasn't evaporated but simply has been pushed back, which does of course bode well for the coming year. On the condition that vaccine rates continue rising and the pandemic eases quickly, the Smith & Nephew could well find itself well positioned to capitalise on all these elective surgeries that have been cancelled over the 18 months or more. Furthermore, a good cost cutting and a solid balance sheet mean that the stocks could weather more storms if necessary. Broker share price forecasts are an encouraging sign, with even the low forecasts still 15% higher than where the share price trades currently. According to the Financial Times, the 10 analysts offering 12-month price forecasts, they've given an average target price of £15.73, a low price target of £13.98 and a high price target of £18.23. From a technical perspective, the Smith & Nephew chart is at a key point. After falling across the year, the share price has found support at £12.10 for the second time this month. Should the price fall again to break this level, then we could see the formation of a double bottom pattern, a bullish reversal which could see the share price rebound higher towards £12.80, the December high, and 50 SMA. However, should the £12.10 fail to hold, then a deeper sell-off towards £11.75, the 2018 low, could be on the cards. Our fourth tip is Vodafone. Vodafone is a telecommunications company which operates in Europe and Africa. It operates mobile and fixed-line services in 21 countries and partners with mobile networks in 49 countries. It services both the private and public sector and also provides connectivity, security and insurance products. So, how has it performed in 2021? Well, Vodafone pushed higher at the start of the year, rising to 142.50 in early May. From there, the share price tumbled 25%, finding a floor at 106 pence, a level last seen in November 2020. More recently, Vodafone has risen 7% as it attempts to rebound from the yearly low. Investors have been selling out of Vodafone despite reasonably solid fundamentals. But the group has a lot of debt, and there's no getting away from that. It has been attempting to sell off assets and reduce costs. However, as the share price has been falling, the debt pile compared to market capitalisation has been more eye-catching for all the wrong reasons. The telecoms industry as a whole has struggled to gain a solid footing over the last few years. Whilst Vodafone stock was hit in the pandemic, it is starting to see revenue rebound. Roaming charges are on the rise as travel starts to recover. Assuming that Omicron doesn't result in long-term travel restrictions, international travel is expected to pick up heading towards summer 2022. Furthermore, customers are expected to start switching up from more profitable 5G contracts. The good news doesn't end there. The EU has put aside €750 billion recovery fund. Around €150 billion of this fund has been set aside to help businesses digitise. Now, Vodafone could benefit directly should companies come knocking on Vodafone's door to help with this digital transformation. Looking further afield in Africa, Vodafone is more of a rising tech start, with its platform M-Pesa serving more than 50 million monthly users. The high growth here should help to support the Vodafone share price. According to the Financial Times, the 19 analysts offering 12-month price forecasts, well, they've given an average target price of 158.79, a low price target of 119.52, and a high price target of 228.79. From a technical perspective, Vodafone formed a series of lower high and lower lows across the second half of the year before hitting support at 106. The price has rebounded off 106. The retaking of the 50 SMA and the RSI moving into bullish territory is keeping the buyers optimistic. Immediate resistance can be seen at the 100 SMA, 115 pence. It would take a move over 119 pence, the November high, for buyers to gain momentum. Meanwhile, sellers could look for a move below 106 to target 100 pence, a level last seen in October 2020. Our fifth and final tip is Wood Group. Wood Group is a British engineering and consulting business, headquartered in Scotland with customers across the globe. Business segments include asset solutions in Europe, Africa, Asia, Australia, asset solutions Americas, technical consulting solutions, and investment services. So, how has the company performed in 2021? Well, Wood Group trades down 40% across 2021. The Wood Group share price quickly rose to $367 in the first week of January 2021, before trending lower. The price currently trades at its lowest level this year at $185, a level which was last seen in May 2020. The stock was hard hit in the pandemic, which caused project delays that are still hurting the earnings outlook now. In November, when we last heard from Wood Group, they warned that annual earnings would be lower than previously expected. Full-year revenues are expected at $6.4 billion, down from the previously expected $6.6 to $6.8 billion, as the pandemic delayed projects well into next year. The company also announced a strategic review of its engineering consultancy, providing some optimism for the future. The group has said that it will consider a range of options to best unlock value from this part of the business for shareholders that Wood believes is not being recognised in its market capitalisation. Now, this review could pave the way for a sale, which would be great to reduce the company's high leverage levels or spin-off of the division. Wood Group is already a global leader in energy transition and in industrial decarbonisation, two areas which are attracting increasing attention. According to the Financial Times, the 10 analysts covering the stock have given an average target price of $284, a low price target of $130, and a high price target of $329. From a technical perspective, after falling lower across the year, Wood Group hit support at 180. The RSI is showing bullish divergence, which suggests the downwards move could be running out of steam and can suggest that a reversal is on the cards. Resistance can be seen at 218, the November high. A move above here could expose the 100 SMA at 240. Beyond here, buyers could gain momentum. Meanwhile, a close below 186 could suggest there could be more downside to come for now. So there you have it, our share tips for the coming year. Thanks for watching. Don't forget we do produce our videos every Monday morning for investors, giving you the key information that you need to stay ahead of the game each week. For more information, why not get in touch with us? We look forward to hearing from you.